Market timing. The idea that you can predict the future direction of stock prices and act accordingly is not a successful investment strategy. In theory, putting money into the market when prices are down and then selling them when they're higher, then buying them again when they're down in an infinite loop is a perfect way to own stocks. The problem is nobody has consistently been able to identify market tops or bottoms. And the cost of being out of the market on the most important days is devastating to a long-term portfolio. Here's a hypothetical example of a $1,000 investment in the S&P 500 over 50 years. The amount invested in the S&P 500 in 1970 to 2019 would have grown to $138,908. By missing the best day of that time period, your investment drops to $124,491. Take the best 5 days out of there, and you're down to $90,171. Missing the best 15 days brings your investment down to $52,246. And missing the best 25 days of the market over that 50-year period, your $138,908 total return drops to $32,763, almost a $100,000 differential. These are amazing statistics. Missing just one day, the best day in the last 50 years, means that you make $14,000 less. That is 10% less money for not being in the market on that one day. Missing the best 15 days, you have a 35% less money. You can see this in virtually any year or any time period. This, of course, works in reverse. Not being in the market for the worst days would have made returns higher, but nobody knows when those days will occur. That's why it's difficult to time the market, because you have to be right twice. You must be right going in when you buy, and you must be right going out when you sell. The probability that you'll be able to make both directional calls and beat the market is very, very small. At Cochrane Wealth Management, we are firm believers that the odds are better stacked in your favor by sticking to a long-term investment program and keeping things simple. Reach out to us either virtually from the comfort of your home or meet with us in our offices when you're ready to see how a long-term balanced investment process can work for you.